Good morning, dear students. Welcome to the home mentoring session of accountancy. Myself, C.S.K. Khanna from the SD Vidya School, Ambala, Kent. Dear students, today we will continue our previous lesson of change in profit sharing ratio among the partners. In this lesson, as we had already covered all the parts, all the segments in our live class as well as in our reading class relating to valuation of goodwill, accounting treatment of goodwill, accounting treatment of accumulated reserves, profits and accumulated losses, accounting treatment of various types of the reserves like the investment fluctuation fund, investment fluctuation reserve, workmen compensation reserve, and also various other capital reserves which are of free nature. I had also shared with you that how the revaluation of assets and liabilities being done and how the accounting treatment of revaluation of assets and liabilities being recorded in case of change in profit sharing ratio. Today we will understand some of the numericals which are very easy with reference to this important aspect. Over to this question number 24. It says A and B are partners in a firm sharing profits in the ratio of 3:2. They decide to share profits in the ratio of 3:4 with effect from April 1, 2016. On that date, there was a credit balance of 70,000 in their profit and loss account past the necessary journal entry, assuming that partner decide to distribute the profits. Dear students, with reference to the accounting treatment of goodwill, accumulated profit, reserves and surpluses, result of revaluation of assets and liabilities, we have to see that there are the two important alternatives. First important alternative say that they had decided to distribute the profits, and second they had decided not to distribute the profits or not to disturb the values of the assets and liabilities or the other account. Now in these two different alternatives, we have to understand how the treatment is to be done. For example, coming to this particular question, A and B share their old ratio 3:2, their new ratio is 3:4. But come to the last line in this question, pass the necessary journal entry assuming that partners decide to distribute the profits. Now, if the partners had decided to distribute the profit or losses, in that case, you have not to calculate any gaining or sacrificing ratio, just only simply whatever the balance is, that is to be shared by the old partners in the old ratio. I repeat, in the first alternative, when the partners had decided to distribute the result or when nothing is mentioned, the only option and only answer is there that whatever the balance is there, that will be shared by old partners in the old ratio. Like here, A and B are two partners and their old profit sharing ratio is 3:2. So they had a credit balance in the profit and loss account of rupees 70,000. This 70,000 will be credited to them in their profit sharing ratio. So we have not to calculate any gaining or sacrificing ratio because it is here clearly mentioned that the partner decide to distribute the profits. So 70,000 will be contributed in the ratio 3:2 to the partners A and B. A will have 3/5 of 70,000, that is 42,000. B will have 2/5 of 70,000, that is 28,000. So these amounts will be credited to them and the journal entry will be recorded. Profit and loss account debit to A's capital to B's capital with 42,000 and 28,000. Let's discuss other next question that is also very simple, very easy. A, B and C are partner sharing in the ratio of 1:3. On April 1st, 2016, they decided to share the profits in the ratio of 2:4. On that date, profit and loss account disclosed a debit balance of rupees 90,000. Record the necessary journal entry for the distribution of balance in the profit and loss account. Now, dear students, we have to first see what is the alternative there, because the treatment will be according to the alternative. If they want to distribute, then automatically you have not to require calculate any sacrificing or gaining ratio. But if they had decided not to distribute, in that case you have to find out the gaining and sacrificing ratio. Now in this particular question, nothing is mentioned, only one very important information is given, that record the necessary journal entry for the distribution of the balance in the profit and loss account. So they want to distribute. What is the solution? Solution lies that the amount in this account will be debited to the partners in their old profit sharing ratio. We have not to find out any gaining or sacrificing ratio. So as it is a loss, so partners capital account will be debited here. In which ratio? In the old ratio, which is 1 to 3. So here A's capital account will be debited with 15,000, B's capital account debited with 30,000, C's capital account debited with 45,000. To profit and loss account, that is of amount rupees 90,000. So this way we will record the debit and credit or accumulated profit balances depending upon the alternative given in the question. How the amount has calculated? See here, total will be 6. A share is 1 by 6, B share is 2 by 6, C share is 3 by 6. So 90,000 will be divided in this ratio 1 by 6, 2 by 6 and 3 by 6. So this way we have recorded a journal entry relating to the amount of loss in the profit and loss account or the debit balance of profit and loss account. I would continue in my next video relating to the other aspects of this lesson.